Hello, I'm Munffett. This last earnings season it was a real head-scratcher for a lot of people in the tech world. We saw some absolutely stellar results from the giants. I'm talking Meta, Alphabet, posting incredible profits. But then you look at their stock prices, and the stories couldn't be more different. So today, we're going to really dig into what's going on. We're going to unpack this AI arms race and figure out why the market is treating each of these companies so uniquely.
And this right here, this quote really nails the central puzzle. I mean, if you just look at the fundamentals, the raw numbers, the revenue, the profits, these companies are hitting it out of the park, absolutely exceptional. But the market? Totally different reactions. It's a mixed bag, to say the least. So the big question, the one we're here to answer is, why? What is the market seeing that's causing this divergence?
All right, before we get into the weeds, just the standard but very important disclosure. Everything we're about to discuss is for informational purposes. It's an analysis, not investment advice. Our goal here is to understand the strategy, not to make financial recommendations.
So here's how we'll tackle this. First, we'll look at the big bet on AI that all these companies are making. Then we'll go one by one. Meta's high-stakes spending, Microsoft's fascinating supply problem, how Alphabet's core business is roaring back, and how Amazon is weaving AI into everything. And finally, we'll zoom back out to look at the massive gamble they're all taking together.
All right, let's get right into it. The single thread that ties all of these stories together is an absolutely voracious and, frankly, accelerating demand for one thing: AI compute. I mean, think about this. Some people estimate the compute needed to train top-tier AI models is doubling every 6 months. That's an incredible pace. And it's forcing these companies to make some of the biggest, most consequential spending decisions, maybe ever.
So you hear they're all spending billions on AI. Fine. But where is that money actually going? That's the real question, isn't it? Because just saying AI is too broad. Is it going into making their core products better? Is it fueling their cloud platforms? Or is it for those big moonshot bets on the future of AI? The answer tells you everything you need to know about their strategy.
It really breaks down into 3 main buckets. First, you've got them just supercharging what already makes them a ton of money, their core businesses like ads, search, e-commerce. Makes sense. Second, they're pouring money into their cloud platforms, AWS, Azure, Google Cloud, because enterprise demand is just off the charts. And third, well, that's the big one, the race to build the next truly revolutionary AI models. The whole game is about how they balance these 3 things. It's a massive strategic juggling act.
Okay, so with that framework in mind, let's start with Meta. Talk about high capex and high stakes. This is the definition of it.
To understand the market's reaction to Meta, you have to remember 2022. The market has some serious trauma from the Metaverse spending spree. Investors saw that as just burning cash on a dream. But this time, it really is different. This isn't some far-off bet. The spending is going directly into their core products, the ad engine, the recommendation algorithms. They're seeing immediate, tangible returns on that investment. It's a completely different story.
And these numbers, they just lay it all out. Look at the family of apps. We're talking about almost $25 billion in operating income in 1 quarter. That's the cash machine. That is the engine that allows them to fund everything else, to absorb the losses from Reality Labs, and more importantly, to pour unbelievable amounts of money into their AI infrastructure. It's all funded right here.
So here's the thesis for management, and it's pretty simple, really. They believe they've found a virtuous cycle. The more they spend on AI for the core product, the better it gets. The better it gets, the more money it makes. The more money it makes, the more they can spend on AI. It's that simple. They're making a massive, aggressive bet that demand for this stuff is just going to keep going up, and they're building the capacity to meet it.
All right, so if Meta is all about building capacity to meet future demand, Microsoft has a different kind of problem. It's almost the opposite. I call it the supply constraint paradox.
First, just look at this number. 40% growth for Azure in the last quarter. That is just a phenomenal result, way ahead of what anyone expected. This is what's driving the whole Microsoft story right now. It's all about Azure's growth.
But here's the twist, the paradox. Even though they're spending a fortune building new data centers, they're telling us they're going to be supply constrained for at least the next year, maybe longer. And you have to ask why. Well, it's because they're basically their own biggest customer. The demand for AI compute from their internal products, think Office, Copilot, GitHub, is so massive it's eating up the new supply as fast as they can build it. They're prioritizing their own highest return products before selling that capacity to outside Azure customers. It's a fascinating strategic choice.
Okay, so Microsoft is dealing with being supply constrained. Now let's turn to Alphabet, which is telling a bit of a different story. using AI to reignite growth in its absolutely massive core business.
Just take a look at this chart. The spending ramp up here is staggering. An 83% increase in Capex year over year. We're talking about going from $13 billion to nearly $24 billion. That jump alone is bigger than what many large companies spend in total. And make no mistake, this is almost all going towards one thing: AI infrastructure.
And you can see where that money is going. Google Cloud revenue up 34%. That's the payoff. This massive investment is translating directly into growth and helping them gain ground in the highly competitive cloud market.
But here's what's really truly incredible to me. It's the core search business. I mean, this is a business that's already doing over $300 billion a year. A business of that scale and maturity, it's not supposed to accelerate. But it is. And that's the power of AI. It's breathing new life into one of the largest, most profitable enterprises in human history. It's a core growth driver, not just some add-on.
All right, our final company is Amazon. And their story is a little different again. While Google is using AI to re-accelerate its core, Amazon is weaving AI into the very fabric of every single part of its massive empire.
So the number that really got the market's attention was this one. AWS growth re-accelerated to over 20%. Now, you might look at that and say, well, that's not 40% like Azure. But you have to remember the law of large numbers. AWS is running at a $132 billion annual rate. To see a business of that sheer size start to speed up again, that is a massive, massive signal about the underlying demand.
And this is how they're doing it. It's not just about AWS, though they're certainly innovating there with new tools for enterprise AI. No, look at the e-commerce side. AI is in the product recommendations, the ad targeting, even the robots in the warehouses. And then there's the ad business, a $17 billion business that grew 22%, all fueled by AI optimization. It's everywhere. It's a foundational layer that makes every part of Amazon better.
So we've looked at each company individually, but now let's pull the lens back. Because despite their different approaches, they are all facing the exact same strategic crossroad. It's a massive shared gamble on the future.
And it all boils down to this fundamental dilemma. It's a choice between two huge risks. On one hand, there's the risk of underbuilding. What happens if you don't spend enough? You miss the boat on a once-in-a-generation tech shift, you see the entire market to your rivals, you become irrelevant. On the other hand, there's the risk of overbuilding. What if you spend too much and the demand doesn't show up? You're stuck with billions in useless hardware, your margins get crushed, and you spark a nasty price war. It's a terrifying choice.
And what's fascinating is that all four of these companies, independently, have come to the exact same conclusion. As a wise person once noted, the risk of underbuilding is so much worse than the risk of overbuilding. The fear of being left behind is greater than the fear of spending too much. And that single idea, that's what is driving this entire historic spending cycle.
So what we're watching here is an AI build-out on a scale we've literally never seen before. The question is no longer who will build it. They're all building it. The real question, the one that matters for the next decade, is who will profit most from it. Is it the builders? Is it the AI model creators? Or the companies that use this new power to create something we can't even imagine yet? That is the multi-trillion-dollar question.